Okay, so we have a balanced price range in here. A balanced price range. Okay, what is a balanced price range? It comes in many forms. I shouldn't say many, it comes in a couple forms. But as I was mentioning earlier in the workshop video today, we have talked about how markets stay in a range. And when they leave that range, because upside and downside has been delivered on price, it makes it a balanced price range. What happens when it's done over the course of a couple candles and not a multitude of candles? Think about it like this. If I was in a live setting, say if I was on a stadium, or not a stage, listen to me, a stadium. If I was on a stage, okay, and I was in a room full of a lot of you, okay, I would right now ask by a show of hands, by raising your hand up, and you don't need to do it, I can't see you. I know some of you are going to do it. Raise your hand if you have been in trading long enough to remember what a key reversal is. Okay, a key reversal would be a day where it's like this, and this right here, all of this movement here would be absent from the chart, and you would just see the market would be here one day, and then the next day it would be gapped down here, and then the next day it would be gapped up here. And all of this movement would be invisible. All of this movement would be invisible. It would just be looking just like that, okay? That is a key reversal or a island reversal. Very, very classic, old school dinosaur type of trading. And that is essentially what I'm trying to take your attention to, because that element of separation, that once price goes to an extreme, which is what it's doing here, because see what we have here? We have a low. We run through that low, and we do it on a very large candle. And then we come back all the way back over top of that again. So these two candles right here, this represents a balanced price range, because it's reached down to a level, and it's offered on one single pass all this move, and the next candle over here, one single pass. So the way I do this and I define it is this. Which is higher? This candle's low that moves back inside of this up move of this candle, excuse me, this down close, this down movement on this candle eats into this up close candle, but only to this point. This low or this low, which one's higher? Clearly this one. This is the only candle that is defined in the range that this candle goes lower and this candle goes lower. So what I'm saying is the range is from here to here, extended out. Okay, so this makes a balanced price range. All of this in here, I don't care about. I could care less about that. What I'm looking at is this relationship. I'm not sure. It must be the outline. Yeah, it is. So it's the bottom one. Bottom one, right? There you are. So that's the balanced price range here. And what I'm trying to convey to you is that because we had single pass down, single pass up, this is balanced now. Once we leave it here, what that means is this range, you define it by what I just showed you here, the highest and the lowest extreme between both of these up close and down close candles, this entirety of that range, low to high. Where are the bodies of the candles over here stopping? I know, it's some serious shit there, ain't it? That's algorithmic. All the bodies of these candles here are respecting the midpoint of this balanced price range. How the fuck can you go back through any retail stuff and see this being taught anywhere else? It's not. It's not anywhere. These are things that you wouldn't learn by any book. None of that shit exists anywhere. This is stuff that's authorship. So when I'm watching a balanced price range, or if I make mention of a balanced price range, what I'm suggesting to you is that there is a definitive boundary that at which I don't want to see breached on a candle's body. Okay, I don't want to see it move beyond this. In this case, we were looking for what? For dollar, move lower. So a lower move in dollar is what in other asset classes? Risk on. Risk on is dollar lower. So dollar lower, all foreign currency higher, and it gives the freedom for stock indices to go higher. Knowing that the dollar index and index futures are not lockstep, every point higher is a lower move in this or that. It doesn't move like that. Okay, much like when I taught bonds and the yields, how the yields will move and they'll cause a long-term effect on foreign currency because they're going to chase that yield. But the yields can change, and the delay between all of that shifting in the currency, it's not an immediate thing. Just like commitment of traders, net trader position. Just because the commercials are net long doesn't necessarily mean it's time for you to go long. So there's rules to all these things, and that's why it's important not just to simply watch one video or one lecture and think you come away with understanding it. It doesn't work that way. But when I give a boundary to a marketplace and I code in a limitation of how far the market's going to go, it's limited to a degree of this is how far you're allowed to go. But then the wicks are permitted to do a certain measure of damage, which is what we're seeing right here. The halfway point of that range, nobody's going to look at this stuff here, okay, and define it like that. It isn't anywhere else, okay? I codified this, so I want you to understand that. These candlesticks are supporting the idea of the principle I'm teaching to you. It's not limited to just this. It's happening every time I tell you there's a balanced price range. This is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. This is just supporting the idea that it's going to go higher. So what you want to see is you want to see the market want to move up, and then create more power 3. Power 3 is open, down, close, rally, close on the high. Open, drop, rally, close on the high. Do we see it here? Drop small, rally, up, close. Open, drop down, rally, come back, still an up, close. So much of a small little movement you can barely see it, but up, close. We open, we drop down, rally, up, close. What is order flow? What is the order flow at that time? Is it bullish or is it bearish? Bullish. At this time right here, okay, on this candle's close, on the very next candle, on a 15-minute basis, you can use power 3 on that one 15-minute candle right there. As it opens, it drops down. You can be buying anywhere in the upper 50% of this candle here and expect this range here to stay open. Why? Why would this be expected to stay open? You see this candle right here? This is the same thing occurring here with more candles in between. This is all time distortion. I know, this is too complicated. Fuck this, give me a moving average. I know some of you were getting frustrated because but you want to learn, and I'm willing to teach it to you. But you don't need everything. But I'm teaching you how I do these things. How do I determine when I'm doing live executions? I say this is going to stay open. It's optimal for this fair value gap to stay open. You're asking me to teach you, so I'm teaching you. The same element of delivery here and here, that one single candle right here, imagine this one candle. If all these candles from this candle here to here were compressed into one interval, it would be the same thing happening right there, just more candles. That's all it's happening. So my eye is going to this, to this. So now let's use the same criteria, okay? Which is higher, this low or this low? This low. So there's your, we don't want to anchor it to that, okay? Draw that down. Come on. I use it's not a mouse, it's a touchpad thing. Which is lower, the high of this candle or the high of this candle? Let me take this off so you can see. Get off. This high or this high? Which is higher, this one or this one? This one. So this high and this, this low and this high is the two reference points. But you want to expand it down. You want a full encapsulation like we did over here for a balanced price range. So this is a lower fair value gap than this one. To what degree? What measures the distinction between this being lower than that one? It's this candle here. In other words, think of it like this. I know what I want to say, I just can't find the words to, they're escaping me. All right, if we were looking at both fair value gaps like this, which one's higher? This one, right? So to identify and map this out, we use this one as the high, and we drag it down to here. Okay, so all of this is a balanced price range. It should never come back down and through the midpoint of that, meaning there would be a small portion of this gap left open. So let's play devil's advocate for a moment. Say it went down into this range. I would not be concerned about it doing a complete closure here because we have this fair value gap and this fair value gap that basically overlap in this range right there. So we have this portion over here and over here. So this creates what? An island reversal. Multiple candles that are segregated from all the movement here and here. So how I internalize it is all of this right here was manipulation, just like all of this is manipulation. So the purpose is to offset existing liquidity for the purposes of anyone that would be profitable once we get above this high. It's all spending time down there to allow offset longs to be taken out. And who would assume that position if they're getting knocked out? Smart money in the market rallies. Admittedly, balanced price ranges are going to be requiring a lot of education, a lot of teaching. Okay, and I promise you that you don't need it, but you asked me to tell you how I know certain fair value gaps are going to stay open, and I'm not hiding it from you. I'm telling you. This is it. This is what I'm doing to do that. Okay, they're all principles and concepts that I'm using to implement to determine when fair value gaps are going to stay open. And I know I'm talking to you right now over this chart that's after the fact, but I don't know how many of the examples you've watched me trade where I'm doing live examples. I'm entering and I'm managing the stop and I'm taking partials and hitting targets. I don't know how many of those examples I've shown or that you've seen, but they predominantly have been shared on Twitter because I usually put music behind them because I like to do that. But I still show them on my YouTube channel too. But most of the time they're being shared on Twitter because it allows you to see a very small 2 minute, sometimes less than 2 minute and 20-second compression of me executing. And every annotation I'm talking about and showing, if I'm talking about how a fair value gap should be, it would be optimal for it to stay open and not close. I'm using that either as a breakaway gap. These are the two primary functions, okay? Either I'm treating it as a breakaway gap and it should not close fully, meaning like this gap here. Let me draw it in. Man, I should have charged admission today. This is too good for the books. This gap here, it should stay open to be optimal. That means it's the best case scenario to see this stay open. I would say that about this one regardless because it would be treated as a breakaway gap. Why? Because this over here is a balanced price range and it's in equilibrium. And the body supporting that idea is seen here. Then we see price moving here and then we have this big extrapolation, but yet to take out this high. So this is the draw. This is where price would want to reach up to because there's real liquidity above here. What kind of liquidity? Buy side. This gap is moving quickly away from all this consolidation around equilibrium based on that balanced price range. And I know some of your heads are swirling right now, like, what the hell is he talking about? Example after example, spend time with me. Every time there's a balanced price range, I will bring your attention to it, okay? I do it in live executions. I talk about it in advance. I talk about it in tweets. I talk about it in reviews, okay? The more time you see it, the more exposure you'll have to it. But for a breakaway gap, and some of you thought I'd never get to this topic, huh? A breakaway gap is expected to form when, for instance, say we're bullish on a market and you have identified a key level that would support as or be presented as support and that is acting as a discount array. Balanced price range at equilibrium. That's one of the PD arrays that is not taught in the mentorship core content, where I show you the PD array matrix and I give you a spectrum of where they are. A balanced price range can exist in any place in a discount or a premium. So there's no real definitive place where they work in an hierarchy, whereas the hierarchy I show you in the PD array matrix, the ones that are there, that is a static, that is very finite. They nest in that order. But there are other PD arrays, like this one I'm showing you here, and like event horizon. Those things can exist in any range of that spectrum, which we defined as a discount or a premium. Okay, so even if this didn't have this gap over here that creates a balanced price range between these two fair value gaps, the fact that it does this move here and creates the fair value gap, notice there is no gap here. All through here until this candle forms, no gap is there. Everything is efficiently delivered. Every previous high is touched. Every previous high is touched. This one goes outside the range of it and even goes deeper. But then you have this big extrapolation of the upside. So this gap here, even if this wasn't here as a fair value gap, this gap that's shaded here, the one that's shaded, let's put it that way, I would treat that regardless of the gap on the other side here. Whether that's there or not, this is classified to me as a breakaway gap, meaning that a breakaway gap, I don't want to see it completely close in. It can come back down to half of it, but because there's a balanced price range here, I wouldn't want to see even half of it traded to. So then you would see me say, I want to see this trade, remain open. It would be optimal for this to remain open. But the very next candle here, the same thing. You would expect it to do what? You can see it open, and then the previous candle's high over here, overlapping this one, that would be otherwise a fair value gap if this wouldn't make the low as it did here. This low completely returns back to that candle's high. So any movement from here down into that, you could be a long entry. Or if you're already long, you can pyramid. So when you see me showing you a 1 minute chart or a 3 minute chart, whatever time frame I'm utilizing, I'm showing you, I'm not trying to hide anything from you, but I've been very open and candid about that I'm looking at other time frames. So this is a 15-minute candlestick chart. If you were watching all of this movement from the open of this candle down to the low of it, and then we're watching it on a 1 minute chart, it would be not so clear probably to what it is it would be the factor for me to trust that drop down, where some of you might be freaking out thinking, it's hitting this area or this area and in that resistance or whatever. I don't feel those problems or fear because I'm trusting that the order flow is being supported by every candlestick. That's real order flow. All the candles are supporting each other. There's no trend line required. There's no moving average required. There's no VWAP required. Nothing. It's pure price. Just pure price. And then we get one down close candle, and that happens after the high's taken out here. Where does it trade back down into? Relative equal highs. All of this overlapping in between this area here, that is creating a very strong balanced price range in and itself. All of this movement in here, it's back and forth, back and forth. So it's showing that it's not willing to go below 15,216. So what is it more likely to explore? Buy side that's existing. Where would that be? Above here, and keep pressing higher. So it's a matter of reading a lot of things that if you're really not interested in becoming, versed in what it is I teach, this is where we depart, where you're like, okay, this is too much. I'm not interested. Okay, it's just too much. It's contrived. It's conjecture. It's hindsight. It's that. But I'm telling you, everything that I'm doing when I'm doing the executions and the things I'm leaning on when I give you the analysis, like I did on the 13th, you know, it's based on all these things at the time when I'm looking at the chart. And when I'm watching a 5-second chart, a 15-second chart, 30-second chart, a 5-minute chart, or an hourly chart, all of these things I'm looking at. Notice that the same things that I'm looking at are continuous: discount or premium, inefficiency or liquidity. The only separation from those things for analysis purposes is the relationship to the balanced price range or the lack of a balanced price range. Did you pick that up? There's no necessity for you to understand the balanced price range. Just know that you will see things that will not present an opportunity for you because you don't understand it. Notice that you would not need this to take any trades. It just gives you more clarity about how to read price action and know where you are in that price delivery continuum. Where are we at in relationship to where price has been and where is it heading? What reference points is it using for a new point of buying, where you can then break that down into smaller fractals, which is what I've shown you here with each individual candle.